So the first step in the no chase swing method is marking high probability zones on the higher time frame. This is going to be the foundation of every single trade that we take. Now, a zone only matters if it comes from a clear cause and effect, and that means one of two things. The first is that the zone created a liquidity sweep. It can look something like this, where we're trading basically in a range, take out lows, reverse direction. So that is a manipulation of lows, and this is going to be the liquidity sweep. So it can look something like this, where we're trading in a range, we take out the low, and then we reverse direction, and then continue in the upward direction. That's going to be a manipulation of downside liquidity. Or it can look like something like this, where we're trading lower lows, lower highs, lower lows, lower highs, and then we trade a little bit lower, and then we reverse direction. So that's going to be a manipulation of the previous lower low. So the second thing is that the zone caused a move that led to a break of structure, or BOS. So on this example right here, we have two structures. We have a smaller distribution followed by a larger accumulation right here. Now, I know we haven't covered distributions and accumulations yet, but just for this example's sake, this is kind of what it looks like. So in this example, we have two microstructures. We have a distribution and an accumulation. So the accumulation we can see is responsible for breaking structure to the upside of this previous distribution. So this accumulation caused the break of this distribution. So in this bottom example, if the price only came up to here, but it failed to take out this high, I'm no longer interested in taking any trade from this zone right here. So here's my exact process for finding zones. For step one, I'm going to go to the higher time frame, and generally I like to use the daily or the weekly chart. Step two is I'm going to look for where price made a clear break of structure. So if we go back to the previous example, I'm going to look where price took out previous highs, not where price came close but failed to break a structure. So step three is I'm going to trace back to the origin of that impulsive move. That is going to be our zone. So now let's go to an example. So for the first example, where the zone created liquidity sweep, we can see that we had liquidity sweep, break a structure to the upside. Now, typically the zone that's responsible for breaking structure to the upside is usually in a discounted area. So that means it's going to be at the lower half of this sell to buy movement. And if we look over here, it's very similar. It's going to be at this premium, and it's going to be at the sell to buy movement. And if we look at the case below, we can have technically two potential structures right here. We have technically a liquidity sweep right here, and then a break of structure to the upside. So this could be our zone. And technically, this could also be our zone because this is the last unmitigated zone that caused the break of structure to the upside. So step four is we make sure that we draw the zones cleanly. I don't make every little swing, only zones that create the break of structure. So now let me show you an actual example. So this is going to be a case where we have a liquidity sweep followed by a break of structure. So you can see that liquidity is clearly marked on the bottom. So this is a typical retail move where people trade wedges and other diagonal trend lines. So a lot of people, when price approaches the bottom of this trend line, they're going to buy. And as a retail buyer, right, if price goes below, you're going to take a stop and get stopped out. And in this case, that's exactly what happened. So price briefly dipped below and it swung back, reversed, and it took out this previous high right here. So this is going to be our liquidity sweep. Now, if we look at the chart closely, you can see that this area right here, where we have a sell to buy candle, that's our manipulation, this is going to be the origin of our zone because this is what caused the actual break of structure to the upside. Okay, so here's an example of a zone that is not valid. Right here, we have an impulsive move to the upside, and this looks like a pretty strong impulsive move. Now, some people would mark this as a valid zone, but for me, it's not valid because it doesn't have proof of strength. If it was so strong, it should have been able to take out previous highs, right? We came very, very close to it, but why couldn't we just break past a little bit more? That would have shown and confirmed strength. And look what happens if you would have taken this as a zone. You would have simply got liquidated and stopped out of your position. So the goal is clear. We're only finding clean charts with zones that matter. That way, when price comes back, you know it's returning to a level that already moved the market with strength. So now I'm just going to go through a few examples of zones that are valid and zones that are not valid. So here's an example of a valid zone. We have our classic liquidity sweep. We have our break of structure to the upside. And if we look back at the chart, we can see that we have this large area of inefficient price action. And this was the cause that broke structure to the upside. So this is going to be my higher time frame zone. Okay, so here is an example of a zone that's not valid. So we have an impulsive move to the upside right here, right? And we even have something that can maybe be considered a liquidity sweep of some sort. But what we fail here is we do not have a break of structure to the upside. This zone has not confirmed any strength. It just simply came to this area of imbalance and sold back down. If it had strength for real, it should have been able to take out this high and then retrace to be mitigated again. So this is an example of a zone that's not valid. So this is lesson 2, and it's waiting for price to retrace. This is where the no chasing comes into play. So once you mark your higher time frame zone, the next step is patience. So I don't chase price action after breakout. I simply let price come back to me. Here's why. When price makes an impulsive move away from a zone, it usually leaves behind inefficiencies. Price almost always wants to come back and rebalance those inefficiencies. If price never retraces, that's fine. Missing a move is better than forcing a bad entry. And chasing is how you end up with poor risk to reward and emotional trades. So in this step, all I'm doing is waiting. I have my zones marked and I know where I want to take a trade. And now it's about letting the market come to me. Lesson 3, lower time frame confirmations. So once price retraces into our higher time frame zone, you don't enter blindly, you wait for confirmation on the lower time frame before executing. There are 3 different valid confirmations. The first one is going to be a liquidity sweep plus break of structure. So this basically looks the same as the higher time frame structure I have drawn here, but it's just going to happen on the lower time frame. So as price comes into our higher time frame, we're going to look for something like this. It literally looks the same, right? So it's just a smaller version of what we have on the higher time frame. So that's going to be the liquidity sweep plus break of structure. So the second confirmation is an inverse fair value gap. So right here we have a higher time frame that is bullish, and on the lower time frame we have bearish price action right here, and we have bearish inefficiency right here. So as price comes into our higher time frame zone, we mitigate that inefficiency with lower time frame bullish price action, which in the process also creates lower time frame demand. So the third confirmation is if we have a volume surge as price comes into our higher time frame zone. So we have our higher time frame bullish structure, and on the lower time frame, as price comes in, we can see that we have volume surge, and this volume is higher than any other volume in previous candle, and this could be our third confirmation. So lesson 4, executing with limit or market orders. So once I confirm the setup on the lower time frame, now it's time to execute. So some of the time I'm going to use limit orders, and I set my entry at the order block that formed after lower time frame confirmation. So this is with a defined stop and with a defined target. And this lets me plan the trade in advance and removes emotion. So on this example, we can set our limit order at the beginning of this lower time frame zone with a stop just below and with a target targeting local highs. But sometimes if price taps into my zone and gives me confirmation while I'm at the screen, or you're using something like options, I'll have to use a market order to get in immediately. So the key is that confirmation has already happened and I'm never just blindly chasing. So your stop loss always goes at the invalidation. So you can either draw it at the lower time frame invalidation point, which is going to be right here, or you can even draw it at the higher time frame invalidation. Now, from my experience, depending on your risk to reward and what you're comfortable with, typically the higher time frame invalidation is going to give you a higher win rate, but with a smaller risk to reward. But this is usually how I trade. So lesson 5. So this is going to be a case study with a full trade example breakdown. So now let's put together everything with a real trade example using the no chase swing method. So step 1 is finding our higher time frame zone. So in this example, we have our liquidity sweep right here, followed by a break of structure right here. And you can see that we have imbalance right here. So this is the beginning of where this dark black candle is. And this is the origin that caused the move up. that broke previous structure right here. So this is my higher time frame point of interest, my higher time frame demand zone. So step 2 is we let price retrace naturally. So that was pretty easy. So now that price is inside our zone, now we have to look for lower time frame confirmation. So step 3 is looking for lower time frame confirmation. So in this example, I actually have a combination of multiple confirmation that gives me confidence in this trade. So on this 1 hour time frame, we actually have a liquidity sweep right here. So we can see we have effectively equal lows, low, low. They're all around the same level. Or if you want, you could either call this an ascending trend line. So either way, this is going to be a liquidity sweep of some sort. So immediately after our liquidity sweep, we can see that we have an inverse fair value gap become invalidated. So right here, we have imbalance. This is the large solid black area right here. And we have a bullish candle that completely overtakes and invalidates this area. And there's basically no local supply above right here. So as soon as this candle closes, we could technically enter. And so that's what I'm going to do. I'm going to enter right here with a stop just below this lower time frame low. And I'm going to target this higher time frame high right here. Let's see how this trade plays out. So we can see how the trade played out. Price tapped into my level, it held my stop, and it pushed clearly into my target. So this is the no chase swing method in action. Higher time frame zone, patiently retrace, lower time frame confirmation, and precise execution. So your biggest edge in trading isn't actually technical, it's mindset. You don't need to catch every single move. You only need the best one that fits the no chase swing method. And this means patience, waiting for the retrace, waiting for confirmation, and executing when the trade is clear. Trade less, trade better, stay consistent. And that's how you grow as a trader with the no chase swing method.